For all the changes we've experienced in recent years, some things remain regrettably the same. We all have bills to pay, and those bills generally come monthly, whether it's rent, car payments, or those pesky utility bills. These costs keep coming every month like clockwork. But what if your investments could keep pace with these monthly outflows? Most of us are used to receiving regular paychecks bi-weekly or monthly, making it easier to manage these expenses. But how to cover it when you retire? Because when it comes to our investment portfolios, income often arrives in irregular chunks. Traditional dividend stocks usually pay out quarterly, and bonds might pay semi-annually, which can make your investment income feel inconsistent. That's where monthly dividend stocks come into play. In this video, I will show you the 5 highest paying monthly dividend stocks you can buy today. I will show you how much you can earn from your investment of $10,000. In the end, I will show you a monthly dividend stock that has the potential to pay over $20,000 in monthly dividends. Starting at number 5, we have Apple Hospitality REIT, known by the ticker symbol APLE. This is a real estate investment trust that focuses on investing in income-producing real estate, primarily in the lodging sector. It owns many hotels across various states, making sure of a broad geographical spread that reduces risk and increases stability. It has a current dividend yield of 6.60%. Over the past decade, the company has maintained an average dividend growth rate of 2%, while the average share price has seen a slight decline of -2.47% over the same period. The consistent dividend payouts make it a worthwhile consideration for steady income. Analyst ratings for APLE are positive, while Seeking Alpha and Wall Street analysts both recommend a buy. Looking at future projections, if you invested $10,000 in APLE today, your investment would grow to $10,413 after 1 year. Over a 10-year period, this investment would increase to $17,283. Extending the horizon to 20 years, the investment would grow to $45,074. By the 30-year mark, the investment would be worth $215,280. Paying $41,741 in annual dividends, translating to a monthly dividend income of $3,478. The total value added through this investment would be $205,280, despite a capital depreciation of -$32,991. The negative capital appreciation is offset by the substantial dividend reinvestment, which would account for a significant $238,271. APLE presents a compelling case for investors seeking regular income and long-term growth. Its stable dividend yield, positive analyst ratings, and robust future projections make it a valuable addition to a diversified portfolio. The company's strategic focus on upscale, geographically diverse hotels and its resilient performance in the face of market fluctuations make it a standout choice for those looking to benefit from the hospitality sector's potential. Next, at number 4, we have Green Realty Corporation. ADC is also a real estate investment trust, but it focuses on acquiring and developing properties net leased to industry-leading retail tenants. The company's strategy revolves around targeting high-quality tenants and long-term leases, which ensures consistent rental income and minimizes vacancies. These properties are often leased to well-known brands, providing a level of security and predictability in cash flows. It has a current dividend yield of 4.84%, an impressive average dividend growth rate of 6.21%, and an average share price appreciation of 1%. Both Seeking Alpha and Wall Street analysts recommend a buy. Future projections for ADC are also promising. An initial investment of $10,000 in ADC would grow to approximately $10,584 after 1 year, assuming dividends are reinvested. After 10 years, this investment is projected to increase to $19,934. Extending this projection to 20 years, the investment would grow to $57,672. By the 30-year mark, the investment would be worth an impressive $300,591. After 30 years, total dividends received would amount to $51,966, translating to a monthly dividend income of $4,331. The total value added through this investment would be $290,591. Despite a modest capital appreciation of $17,304, the power of dividend reinvestment is evident as it accounts for $273,288 of the total return. The company's focus on high-quality retail properties with long-term leases ensures a steady income stream, while its strategic growth initiatives offer potential for future appreciation. This disciplined approach to expansion and strong tenant relationships further enhance its stability and potential for continued success. The management's ability to navigate economic challenges and maintain strong financial health ensures that ADC remains a reliable and lucrative investment. At number 3, we have Pennant Park Floating Rate Capital with the ticker symbol PFLT. This is a business development company that primarily invests in floating rate loans and other investments made to U.S. middle market companies. The company's focus on floating rate loans makes it particularly attractive in a rising interest rate environment, as these investments can adjust to rate increases, thereby protecting investors from interest rate risk. The stock has a current dividend yield of 10.66%. which is one of the highest in the market for income-focused investors. Over the past decade, the company has maintained an average dividend growth rate of 1.40%. Despite the modest growth in dividends, the high yield itself provides a significant income stream for investors. However, the company's average share price has seen a slight decline of -2.22% over the same period. This depreciation can be attributed to market volatility and sector-specific challenges, but is somewhat offset by the high dividend yield. Analyst ratings for PFLT are mixed, with Seeking Alpha recommending a buy, while Wall Street analysts suggest a hold. This discrepancy reflects differing views on the company's risk profile and future performance. Supporters highlight PFLT's strategic focus on middle-market companies and its portfolio of floating-rate loans as key strengths. However, critics point to the potential risks associated with credit quality and the economic sensitivity of the middle-market segment. Future projections for PFLT indicate significant long-term growth potential. An initial investment of $10,000 in PFLT would grow to approximately $10,844 after 1 year. After 10 years, this investment is projected to increase to $26,769. Extending this projection to 20 years, the investment would grow to $115,180. By the 30-year mark, the investment would be worth an impressive $940,073, paying $220,126 in annual dividends, translating to a monthly dividend income of $18,344. The total value added through this investment would be $930,073, despite a capital depreciation of -$88,989. This negative capital appreciation is offset by the substantial dividend reinvestment, which would account for a significant $1,019,062. Despite the stock hitting $1 million, it lost value due to capital depreciation. In the end, I will show you a stock that has the potential to turn a $10,000 investment into over $1 million and pay over $20,000 in monthly dividends. At number 2, we have SL Green Realty, known by the ticker symbol SLG. This is one of the largest commercial property owners in Manhattan, specializing in acquiring, managing, and maximizing the value of Manhattan commercial properties. With a substantial portfolio that includes some of the most iconic buildings in New York City, SLG stands out as a premier player in the urban commercial real estate market. It offers a current dividend yield of 5.30%, backed by a strong dividend growth rate of 5.83%. Despite a slight decline in the average share price of 1.60% over the same period, the consistent dividend payouts provide a reliable income stream for investors. Analyst ratings for SLG are generally favorable, with Seeking Alpha giving it a strong buy rating and Wall Street analysts recommending a hold. Future projections for SLG indicate substantial growth potential. An initial investment of $10,000 in SLG would grow to approximately $10,370 after 1 year. Over a 10-year period, this investment is projected to increase to $17,677. In 20 years, the investment would grow to $63,600. By the 30-year mark, the investment would be worth an impressive $848,596. After 30 years, the total dividends received would amount to $255,359, translating to a monthly dividend income of $21,280. The total value added through this investment would be $838,596, despite a capital depreciation of $43,651, while the dividend reinvestment would account for $882,246. The company's focus on high-quality commercial properties in Manhattan ensures a steady income stream, while its strategic growth initiatives offer potential for future appreciation. Its strategic focus on Manhattan, combined with its ability to manage and enhance the value of its properties, positions it well for continued success. And now, topping our list at number 1, we have Banco Macro SA, known by the ticker symbol BMA. BMA is one of Argentina's largest private sector banks, providing a wide range of banking products and services to individuals, businesses, and government entities. With a solid presence across the country, Banco Macro has established itself as a key player in the Argentine financial sector. The bank's extensive network of branches and ATMs ensures broad accessibility for its customers, enhancing its market reach and stability. The bank's extensive network and established market presence position it well for continued success, even amid economic volatility. BMA offers a current dividend yield of 7.99%. Over the past decade, the company has managed to maintain a sector average dividend growth rate of 7.77%. Additionally, the company's share price has appreciated by an average 3.92% annually over the last 10 years. Analyst ratings for BMA are mixed, with Seeking Alpha and Wall Street analysts both recommending a hold. This cautious outlook is influenced by Argentina's economic volatility and the associated risks of investing in the country's financial sector. Despite these challenges, analysts acknowledge BMA's strong market position, sound management practices, and resilience in navigating economic fluctuations. Future projections for BMA are highly promising. An initial investment of $10,000 in BMA would grow to approximately $11,191 after 1 year. Over a 10-year period, this investment is projected to increase to $35,293. Extending this projection to 20 years, the investment would grow to $181,789. By the 30-year mark, the investment would be worth an astonishing $1,586,141. After 30 years, the total dividends received would amount to $296,675, translating to a monthly dividend income of $24,723. The total value added through this investment would be $1,576,141, which includes a capital appreciation of $253,978 combined with a significant dividend reinvestment of $1,322,163. Want to learn how to double that and reach a $3 million valuation? Click the video on the screen.